The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, so Thursday the 16th. Good to see you again, Jeremy. How's your week been?
Yeah, pretty good. Probably not as good as yours. You're in sunny Turkey, I gather.
Yeah, I am. It's been fantastic here this week. A place where East meets West.
Yep.
But it brought to my mind the conflicting pressures, the way that different people have been thinking about the markets and the positive and the negative, and whether we can manage that interface well, because it feels like sentiment's shifting quite quickly and there's a lot going on. So it feels like there's a bit to talk through.
Yeah, well, you've been sunning yourself. Back here, we began the week with a weakening yen and a stronger dollar and generally tighter financial conditions building up ahead of what was going to be and has been the big event of the week, which is the US inflation report. Before we got that, we had UK unemployment data and average earnings data earlier in the week, both of which reported increases month on month. So that kind of, particularly the average earnings figure, dampened hopes, I think, of an early UK rate cut, perhaps.
Okay.
And the other event we had was yesterday, quite a significant spike in the copper price, driven by activity on the futures markets in the US. And I think largely explained by increased demand coming from China, and debate going on whether this is a reflection of their recovery coming through or them hoarding in expectation of some future event. But the underlying copper price is now decisively moved into clear all-time high territory. So given the importance of copper, Dr. Copper, it gives us a prognosis of what the world economy is like, so we're told. I think this is one that's just worth keeping an eye on. And of course, it's the backdrop to probably the main drama in the UK equity market of recent weeks, which is the BHP approach to Anglo-American, which is about the push to get access to Anglo's high-quality copper reserves, which is believed to be hidden in the other activities such as De Beers and its cash-draining UK polyhalite activities. So, yeah, quite a lot going on, but undoubtedly, the big news of the week, the market-moving news, was the US inflation print, which, as everyone knows, came in below expectations for the first time in a number of months and changed everything. So the US dollar and the 10-year yields weakened, and all the recent indicators of financial stress, like US dollar, Japanese yen exchange rate, moved back. And we've had a big response with significant price rises in risk assets, which obviously includes equities, but the liquidity-fueled favorites, if you like, such as the meme stocks in the States, GameStop, if you remember that one, is back stonking away. Bitcoin and silver were all up significantly in the hours after the print.
Yeah.
And it does feel like we're more similar to the regime we had in the fourth quarter of last year, which was obviously very positive for the UK particularly.
It was, and it feels like it's been a very, very quick recovery of sentiment and overall market view on the back of that one number, doesn't it? So it made a big, big difference.
Yeah, and I think one has to be careful what you wish for in situations like this. The well-regarded market strategist Ed Yardeni wrote yesterday that he believes the Fed is about to make a mistake if it cuts rates prematurely and risks triggering what he described as a market melt-up.
Okay.
There are memories here of what happened in 1998 ahead of the dot-com boom, which maybe equity market followers might welcome, but one has to be very careful how sustainable some of these risk-on moves could be. But I think for the UK, with the pound holding up and sort of nudging up to the 127 level, despite having signalled last week that it might be prepared to reduce rates next month, I think there's a cushion there now, because I think the UK can now consider cutting rates without triggering a currency problem.
And that's because you've seen sterling remain strong despite the fact that they flagged that there was a possibility and the forex markets haven't panicked.
Yeah. And now it looks more likely, given this inflation print, that the dollar rates will come down as well. So sterling strength is a reflection of dollar weakness.
Understood.
The dollar index has come down post this print. So it just gives that extra bit of cushion for us to make that brave decision next month to cut rates ahead of the Fed.
Yeah.
So, yeah, it does feel like UK equities are in a bit of a Goldilocks scenario at the moment. The FTSE 100 has hit the largest number of monthly all-time highs this month since its inception in 1984, according to Simon French at Panmure. And on his analysis, despite the recovering nature of the UK market, still remains on a significant, he believes, a 17% discount relative to peer markets on an adjusted basis for sector composition and size and so on. So people who might be looking and seeing the market go up and thinking they've missed it, on his analysis, they haven't.
And from a global investor perspective, the UK is still cheap and still potentially attractive despite some of the quite positive recent moves.
Yeah, and as you well know, once we get the momentum, that's when interest widens. So where we are currently, I think there's more to go for. And we've got IPOs again.
We do. I was just going to say, turning to the UK, in terms of smaller and mid-sized company news, the big news from this week was Raspberry Pi, basically confirming that the UK will be their venue of choice for their flagship IPO. And I couldn't be more pleased with that, to be honest. It's a great technology. It's got some great backers and some really strong heritage. So it's great that they've chosen this as their venue. And as our colleagues, George O'Connor and Ian Robertson, were saying last week on their tech talk, their view has been very much that the UK has been for many years a great place for small and mid-sized technology businesses to grow and prosper. So it's great to see Raspberry Pi making that decision and looking to IPO in the UK.
Yeah, as you say, it could become a flagship transaction for a new era for the UK equity market renaissance.
The reality is, the UK did have and still has had a great track record of finding, fostering and then growing some really small tech businesses into pretty meaningful global organizations. So it would be great to see that coming back as a trend.
Absolutely.
So other news we've had from a couple of our smaller UK quoted corporate clients. Zoo Digital had a positive update and we had some good results and again positive sector view from Vertu Motors earlier in the week. Zoo Digital, quite company specific to their translation and dubbing markets, but Vertu Motors probably slightly broader in terms of its impact or its relevance to a number of different areas. Any other stocks caught your eye?
Well, I guess on the technology front, we had H1 results from telco software provider Cerillion this week, which the comments you were making about Raspberry Pi, Cerillion fits that specialist technology market niche approach, but growing a niche such that it becomes a global player. And Cerillion is a 25-year-old business that has taken that amount of time to become an overnight sensation. It's now a billion pound plus business. And it announced its largest ever new contract win from a South African telco worth £11 million this week. So, the other one that caught my eye, actually on the negative side, we had a profits warning, not the first either, from the flooring distributor Headlam, saying that it has not seen the usual seasonal uplift and it was materially lower in guidance. It's increasing its efforts to reduce costs and to realize cash and capital from disposing of surplus properties. So one of the factors here is that the previous CEO of Headlam now runs his own competing business called Likewise, who I've interviewed on in the Company of Mavericks podcast. And he's doing a very effective job. He's up to a sort of £150 million of revenue run rate and driven the business to scale since launch 6 years ago. So one of the things going on with Headlam is it's as company specific as it is sector generic, if you like.
I mean, that house building or the consumer big ticket spending, it's a tricky one to pin down, but Alistair Stewart's been very positive on the house building space for a while. And we saw this week, I think, from Vistry, which is the old Bovis and Galliford Try house building countryside partnership. They have increased their expectations apparently for home sales. So that's the first time Alistair's seen that for some time. So clearly there's a mixed picture in terms of the UK consumer and what they're prepared to spend on and how much.
It also depends where you are in the process. I
Of
mean,
course.
to build more houses, you've got to buy the land, then you've got to buy the bricks, you've got to do the earthworks, and
Yep.
actually laying the flooring is sort of quite late on in the day.
Later
So,
on.
yeah, I think the outlook for Headlam and likewise could improve down the road.
Yeah.
Couple of stocks I'd highlight this week: Hunting, which is the oil services company, and Future, which is the publishing business, but it also owns Go Compare. They're both reasonable sized businesses. They both had positive updates this week. I wouldn't say either of them were knockout updates fundamentally. They're both good news, but both saw significant price action, 20% up on the news.
Okay.
I suspect what's happening here is the price action is being driven by better flows into the UK, a better outlook for the UK, but also I think these companies had reasonable short interests in them. I haven't checked on that. And I think just worth keeping an eye on the price action here when people want to buy these illiquid stocks where people have to cover shorts and it becomes very self-fulfilling very quickly. I think one has to be wary of these situations, or aware of them at least. Yeah.
Yeah. And what about next week? What have we got on the calendar coming up?
Next week, it's mainly going to be about UK inflation, I would say, is the big one. Wednesday, we're going to get inflation data for April, and the market's looking for a year-on-year figure of 2.7% versus 3.2% for the previous month in March.
Sounds good.
But actually, if you dig a bit deeper, the month-on-month figure is expected to actually go up from 0.6% to 0.7%. The year-on-year decline's actually all to do with the high numbers for April last year. April last year was the highest month-on-month inflation print since 1991 at 1.3%. That figure now drops out. So the year-on-year figure declines mechanically, i.e. it's a base effect.
The maths, yeah.
So I think it's going to be interesting to see how this is reflected, whether the media pick up on the lower year-on-year number or look at the month-on-month figure.
Yeah.
Now, I think going forward, we are trending down towards 2%, but I think it might start to look a little bit more of a struggle than perhaps we previously thought. So, nothing happens in a straight line, but I think there's a bit of a data complication there.
Yeah, interesting. Look out for the headlines. Okay, anything else?
So over the Atlantic on Thursday, we get the minutes for the last FOMC meeting. So we'll find out more of the sort of detail behind their policy decisions and any hints of growing push to lower rates or further reduce quantitative tightening, and whether that's emerging. We also get inflation from Japan for April, which is currently running at what they believe to be a very uncomfortable looking 2.7%. So they're coming at it from below rather than above.
Yep.
And we've all been keeping a close eye on what's happening to yen interest rates and the dollar yen FX rate. And then on Friday, we get UK retail sales, which are expected to show an increase to 0.3% month on month from 0 last time. So that looks positive and I think should be taken quite well. And US durable goods orders for April as well, which are expected to slow significantly from a very high 2.6% last month to 0.3% this time round. So again, looks like we'll be seeing an indicator from the consumer at least, which is showing the UK strengthening and the US weakening. So interesting. So what all that means, I don't know. But busy week. But the UK inflation data looks like the key one for next week.
That'll be the main one. So I'll keep an eye out for the way that the media affects that and look forward to catching up again this time next week.
Yeah, look forward to it.
Thanks, Jeremy. Speak to you then.
Okay.
Thanks.
Brought to you by Progressive Equity.